Afternoon, everyone. We'll let our panel get seated. Thanks to all of you for sticking around with us. It's been a great day of policy discussions, and we hope to continue that high standard here with this discussion. As some of you know, some of you maybe don't know, I'm Ben White, the chief economic correspondent for Politico. Write the Morning Money column that hopefully some of you read and is not always dominated by Yankee references. I'm told by Dennis that I focus too much on baseball from time to time, but this is a Red Sox fan, so...
I didn't say you focused on baseball too much. I said the wrong team.
The wrong team, so he's biased. Thrilled here to be here with an incredible panel to discuss the financial crisis 10 years later. Hard to believe we're 10 years down the road from that. We're going to talk about whether banks are safer and the financial system is safer now than it was 10 years ago, the state of financial services regulation under the Trump administration, and where the next crisis might come from. So somehow we're going to do all of that in 29 minutes with 4 people. So we'll try to be as quick as we can. Joining me, Dennis Kelleher is President and CEO of financial reform group Better Markets. Congresswoman Gwen is Democrat of Wisconsin, sits on House Financial Services. Very pleased to have her with us. Jeremy Newell is Executive Managing Director and Head of Regulatory Affairs and General Counsel at, I was about to say the Clearinghouse, but it's now the Bank Policy Institute, newly reconstituted. And Ken Rogoff, most of you will probably know, is the Thomas Cabot Professor of Public Policy and Professor of Economics at some university in Cambridge you might have heard of called Harvard. Welcome to all of you. A pleasure to have you. I should also note that we asked a number of Republicans who are in favor of more regulatory rollbacks to join us on the panel, and all of them declined. So we just have a Democrat, not a Republican, but not for want of trying. All right, so let's get right into the panel. I want to start down at the end with Ken to kind of set the historical stage for us 10 years later. And my question to you, Ken, is so we're 10 years away from the worst financial crisis since the Great Depression. A lot of us lived through that. It was a scary time. How would you characterize the safety and soundness of our financial system, given the reforms that were enacted in Dodd-Frank, and some of which have been tweaked or rolled back a little? How safe are we now 10 years later?
Well, I think we are safer. A lot of it comes from when the whole system's been traumatized. Consumers, investors, policymakers, regulators, you're less likely to have something right away afterwards, that these massive systemic crises don't tend to come one on top of another, whatever legal response, whatever restrictions you put in. People are very nervous. I think we see that even in the low interest rates. People are scared. They want safe stuff. That said, usually it takes many decades before everybody says, hey, things are going great. Why do we have all these regulations? Let's pull them back. That's a very typical dynamic. My political science colleagues have documented that a lot. We kind of had that faster this time, so maybe we could get in more trouble quickly. And I might add, aside from the banking system, the world's morphing a lot with fintech. And I don't know that the next crisis is coming out of the traditional banking sector. It might come out of there.
Yeah, interesting. I want to get into fintech and the sources of the next crisis a little bit later, but Congresswoman, let me go to you. Ken mentioned the idea that we've sped up the timetable on regulatory reform, rollback a little bit more than perhaps you've seen in previous crises. In the response to that, there have been some significant changes to Dodd-Frank. Talk to me from the congressional perspective, your perspective on what's been good in any of those tweaks and what's been bad and perhaps dangerous that could make us less safe.
Well, I became the legislator of the year for the insurance industry, and they awarded me with this Ben Franklin statute. So that was really reminiscent of something that he said early on when they signed the Constitution, and they asked him what kind of government we have, and he said, well, we have a republic if we can keep it. So I reflect on that, and I think about Dodd-Frank, which really put the rules of the road, really looked at the vulnerabilities that were in our financial system and tried to bridge them. And I just think that some of my colleagues didn't learn their lessons as they roll back these regulations. We had the Consumer Financial Protection Bureau, which really recovered $13 billion for consumers. And they have not given up on trying to destroy that at all. We had an orderly liquidation facility so that we could destroy the too big to fail phenomenon and really have a way to unwind that. They have gone after those things. And, we try to do more clearing of swaps. I think that's been a benefit. But I think that the rolling back of regulations is too soon. And I'm not going to hog all the time. I'll just mention that as a Democrat, I have caught a lot of hell from the left when I have felt that this huge piece of legislation, Dodd-Frank, wasn't perfect, and that there were places that there was an overreach in regulation, and to try to be more moderate. And I can think of several things that I personally did to try to do that. But this sense that we're going to roll back everything and stop all regulation, it really is a setup for a setback.
And I mean, just specifically, you have legislation on the floor now that would loosen regulations a little bit on small investment advisors, right?
Exactly. We're going to take that bill up tonight. I call it my bill, but it actually has a name called the Investment Advisor Regulatory Flexibility Improvement Act. I mean, this was an act instituted in the 1940s. We tried to change it in the 80s, but it really didn't give any flexibility to these firms. Often had 10 employees or less, minus the clerical staff. And so this is the perfect example, thank you for raising that, of where, sometimes just common sense ain't common. And it's a common sense fix, but it is not throwing out all regulation and just back to laissez-faire, no regulation, nobody watching the store.
And have you gotten a lot of flack from progressives on the left for this particular bill? Because it does sound like, we're deregulating investment advisors. That could be dangerous.
Not this one in particular.
Okay.
But I do have my list.
Yeah, gotcha. Okay, I'm going to get to you, Dennis, in a second, I promise. But Jeremy, first, I want to ask you about big banks. The perception around Washington is financial services industry in the CRAPO bill got a lot of what it wanted. Smaller financial institutions got a lot of what they wanted, but big banks have not gotten much Dodd-Frank changes or reliefs. I know Dennis has thoughts on whether they deserve any of that, but specifically on...
Excuse me.
On capital levels, the larger banks are interested in the idea that capital is much stronger now. The banks are in a much stronger position than they were at the end of the financial crisis, that we're a lot safer, and something specific like the GSIB surcharge should be rolled back a little bit. Give us a big bank perspective on what we should be changing.
Yeah, sure. So, I think you immediately went to capital rules, which I think is a very important area. It's one of the things too. I think it's important always just to remember. We focus a lot on Dodd-Frank, but a huge part of the bank regulatory regime actually just comes from the Basel capital rules and the other more traditional prudential regulatory tools. And we have seen enormous changes in capital regulation since the crisis. I mean, I think. Again, one of the things that's underappreciated is just how much more capital there is in the system today relative during the crisis. If we look at our 48 members at BPI, at about $400 billion of common equity tier 1 capital. In the crisis, that's $1.2 trillion today, right? So a lot more capital in the system. But when we look across the capital regime now, whether you're talking about the GSIB surcharge, the CCAR stress testing exercise, some of the leverage ratio components. And again, not that there's any push to get rid of those things altogether. That's certainly not the case. I mean, for example, we think stress testing is an excellent way to ensure that banks are resilient. But it really goes to the question of calibration and the underlying mechanisms, right, to make sure that they're as efficient as possible. All of these rules were put in place incredibly quickly, incredibly rapidly, right, in the aftermath of the crisis. So there's no way that they're going to be perfect, just like there's no way Dodd-Frank is going to be perfect. So I think one of our focuses at this point really is taking another look at those, making sure that they make sense on a holistic basis, and probably most importantly, make sure that while we're doing what we need to do to make sure that banks are safe and sound and resilient, we are not undermining banks' ability to do what they're here to do, right, which is to lend to businesses and consumers and to support economic growth.
Dennis, I think you might have a slightly different view of this particular subject, or maybe even what big banks are here to do. But I want to ask you, sort of specifically on what Jeremy said about the idea that we could tweak capital levels, particularly the surcharge for the systemically significant institutions. That's a big agenda item for them now. But start at the broader level, which is we had Dodd-Frank. We've had some of these rollbacks in the Crapo Senate banking bill. Did those make us less safe, or were they reasonable changes that will help the economy thrive more and banks do what they're supposed to do, which is lend and grow the economy?
Well, I think it's important to take a step back. And, I think it's just, heart-wrenching to hear about how tough it is on the banks. We come at it at Better Markets from the focus of America's families and taxpayers who, after all, funded the bailouts of these banks 10 years ago. We did a study at Better Markets on the cost of the crisis. It's going to cost the United States more than $20 trillion in lost GDP. One crisis. It caused the worst economy since the Great Depression of the 1930s. And what was put in place in response was a law, admittedly imperfect. I worked in the Senate for 8 years. I don't recall a single law that passed that was perfect. I don't know if you do, Congresswoman.
It hasn't been
They
done.
don't. It was the best law our political system could produce at the time, and it had 3 key objectives. Number 1 was to prevent crashes or make them less severe. Number 2, protect consumers and investors. And number 3, and very importantly, and Jeremy alluded to this, but Dodd-Frank was meant to refocus the banks away from the high-risk prop trading gambling that boosted bonuses and get them back in the business of lending to the real economy and supporting businesses and individuals, which is, after all, why they are backed by the government and taxpayers. Not for their bonuses, but what they're supposed to do for the real economy, jobs, growth, and prosperity for the American families. And so here we are just 10 years later, and Ken's dead right. Never in history has, some people call it amnesia, set in so quick, but never in history of financial crashes has the response been truncated so quickly to where normally what happens is individuals, companies, governments, regulators are all traumatized by a crash. They deleverage, they pull back, they get conservative for many years. And in this case, and then it takes many years, decades, before you start to see the loosening up and people forgetting, and then the leverage going up, what Jeremy would like to see again, leverage going up, prop trading going back up, and those are the 2 fundamental fuels for the next crash. And what we've got is this massive effort seeking to, I love this, tweak. Let's tweak this rule, tweak that rule. You mentioned the Crapo bill, 2155, that just passed. You have to think about, does that in and of itself, kill Dodd-Frank or financial reform? No. But that's the wrong question. The question is, how much deregulation is going on? Well, when you look at legislative deregulation added to regulatory deregulation, which has been delivering for the biggest banks as well as the smaller banks, and you look at judicial deregulation, the risk retention rule, among others, and you add them all together, and you have a massive shift to deregulation, which is right now not critical, but it is slowly corroding and undermining the pillars of financial reform that are protecting taxpayers and American families and our economy. And so when you hear about a tweak, it's like saying, I want to talk about a tree in a forest. I don't want to talk about the forest. Think about the forest, because the forest is being lit on fire.
I wonder, Ken, if you agree with that characterization of what is happening in terms of deregulation of the banks. I mean, if you think about the Volcker rule still being in place, though, of course, there are proposals for changing it, but it hasn't been changed yet. So you can't go back to prop trading or private equity investing or gambling, as Dennis calls it, in the way that perhaps was happening before the financial crisis happened. And at the Fed, obviously you have more deregulatory bent with Chair Powell and Randy Quarles as the head of supervision, but they seem relatively inclined to maintain capital levels pretty close to where they are now. Are we really setting things on fire in the banking industry based on what you've seen in the deregulatory agenda?
Well, I think the point that it's not just about what law you passed, but it's also what regulators you appoint. I think everyone understands if you have someone at the Environmental Protection Agency who doesn't care a lot about it. It has an effect on how they enforce laws. It's the same thing in the financial system. If you basically believe Dodd-Frank had it wrong and you don't really like these regulations, you don't enforce them. And the same thing with judicial. I also want to comment on, I'm not a big fan of Dodd-Frank. I want to be clear. I thought it was done very hastily, thousands of pages of laws, but it's not because it was too tough. I think it wasn't tough enough. Mm-hmm. I think that the real change, and two people who've written a lot about this are Anad Admati at Stanford and her colleague, Martin Hellwig, that banks don't have too little capital. They don't have too much capital. They need a lot more capital. They should have a lot more skin in the game. And what they mean by capital, there's a lot of accounting I don't understand. Read their book of what it actually is.
Everybody has to read that book as soon as they leave here. So
it's called The Banker's New Clothes. It's
very good. But their point is that if most American firms, they get some of their money by raising stock, some of their money by borrowing, and the average is actually close to 50-50. A lot of the tech industry is very little borrowing. And the banks, if you combine the depositors and you combine what they raise from issuing bonds in bond markets, it can, by their calculations, it can be 98%. And so it's not that there's less money to lend or they should do something different, but if you're borrowing more through equity, there's more skin in the game. And I think that's a very important point.
Yeah, and do you think that, and it's obviously important who you put into these key regulatory positions, but the Fed in particular is kind of the locus of bank regulatory capital and where that could change. Do you worry about the Powell Fed and the Quarles Fed in terms of what they'll do in this area?
Yeah, I mean, no. I think I have to be honest, I was kind of worried what would happen with appointments to the Fed at this administration, and I think they've been very good, by and large, the people he's appointed.
Yeah, Congresswoman, you were sort of nodding your head and worrying about the relaxation of the Volcker Rule in particular. Talk to me about your fear there.
Absolutely. You're absolutely right. Dodd-Frank was not perfect and it was not strong enough. I mean, one of the things that we tried to execute there was to require upfront that the banks fund a way to prevent too big to fail and have that funded. We just didn't have the votes for that. Just couldn't get done. The Volcker Rule is constantly under attack to prevent prop trading, proprietary trading with FDIC governed funds. And that continues to be a thrust of a lot of their legislation. And we had more transparency and stuff with the swaps and derivatives. But again, the bill that we just passed sort of puts out of our reach the ability to make sure that we don't develop more systemically risky institutions. The bigger banks are just getting bigger under the kind of laws and rules that we're doing. Let me just, something came to mind while I was sitting here. I'm the ranking member of the Monetary Policy and Trade Subcommittee. Some of the things that happened immediately under this administration's watch was to eliminate regulations around companies identifying the supply chain for oil and gas and minerals. And in Dodd-Frank, we required that to happen. So you think of all these countries, just look at your cell phone, all of those minerals, Tuscan and so on, and blood diamonds and these kinds of things. Companies like Apple, they were very, very happy to get away from some of the corruption by identifying the supply chains, and that was immediately eroded in Dodd-Frank. Something that if we get back in the majority, that'll be HR 1, as far as I'm concerned. I think that without hogging all the time, it's really important to mention that banks are just doing better than they ever have. They have so much money, they're flush with cash. And you talk about the $21 trillion. Well, that was actual money that individuals lost. People who paid their mortgage every single month, and they lost value in their properties. So we did not bail out people, individual mortgagers. We bailed out.
Oh, we tried to. We just
the
didn't do it
banks.
very well.
Yeah, we tried to. Well, people are underwater in their homes. They can't fix their leaky roofs.
Sure.
Because the loan to value ratio is just not there. GSEs. I can't believe we funded transportation out of the returns from GSE monies, and instead of having a robust housing trust fund and using that money for loan modifications and other things, they're using it for budgetary purposes. GSEs, there's a movement, Choice Act and other things. There are movements to have the GSEs, not give the guaranteed backing, and I just don't know who in the private sector can actually do that.
Yeah. It doesn't seem like the
And I
Treasury
mean,
Secretary
there is
wants
no
to do that.
such thing as a recovery without the housing industry recovering, to our knowledge. And so, there are many, many challenges. And Dodd-Frank was not perfect. It was done hastily, but I mean, we were responding to a crisis.
Yeah. Jeremy, let me give you a chance to push back a little bit on the things that Dennis said about what your evil banks are trying to do and that they shouldn't be given the opportunity
Well, let's be clear. I
to do
didn't
that.
call them evil. They're pursuing their self-interest as they should, and
Which
as
is
they're entitled
an
to.
evil self-interest. But seriously, though, particularly on the idea that you're trying to get rid of the Volcker rule entirely. Is that
I didn't
Yeah,
say that.
well, again, obviously I completely
not.
disagree with Dennis's characterization. And again, on each of these things, I encourage people to sort of look past the rhetoric and actually look at the proposals. Because again, you will find that they are, in many cases, quite technical, but in all cases focused on, again, not radically overhauling of the regime, but looking at specific issues, things that have been learned through experience over the past couple of years, and trying to get to a more effective and efficient rule, right? So, for example, one of the Fed's proposals in April around stress testing, a so-called stress capital buffer proposal, right? That's almost element for element, Dan Tarullo's proposal in his farewell speech on stress testing, right? So it's hard for one to conclude that that's radical deregulation. Volcker, again, is similar. I mean, I encourage people to actually look at the regulatory agency's proposal. I mean, for the most part, first of all, it asks an extraordinary number of questions. I mean, I personally don't think asking questions is, radical deregulation. And even if you do look at the concrete proposals that are included there, again, they are things like taking one of three of the definitional prongs of the trading account definition and revising it, right? It's changing one of 9 different tests in order for something to be constitute risk mitigating hedging. Again, so these are actually relatively small changes at the margins. And in Volcker, for example, again, I certainly don't think it's anyone's intent, the regulators or ours, right, to somehow radically change the lines of the Volcker rule to allow prop trading. The reality is, in the Volcker rule, it's an incredibly complicated rule that is very difficult to understand and apply in practice. It's actually also very difficult for the agencies to examine foreign practice, right? So really, again, if you look at that proposal and the actual things that it contains, right, really what it's attempting to do is just get to a place where the rule is more straightforward, it's easier to understand, and again, easier for supervisors to examine for.
Yeah, I'm going to come back to you, Dennis, in a second, but just to follow up on that and his larger point that banks are extraordinarily profitable. We're going through an earnings season where they're doing very, very well. Share price is a little bit less well, but that's for different reasons. But they're not exactly suffering, so why change capital levels for them? Why offer any relief given the extraordinary levels of profitability?
Well, again, I mean, first, I always find it odd that you look to profitability as a metric for whether you should increase or decrease regulation, right? You certainly don't see people arguing the opposite, right? If there are low bag profits, that means we need less regulation, right? I think the regulation that you want is the one that is the most effective and most efficient at the end of the day. So I think that's point one. And two, there's a difference between profits and profitability, right? So certainly in gross dollar terms, profits are up relative to the past few years. But if you actually look at profitability, right, it's certainly not the case that banks are showing record returns on equity, for example.
Yeah, well, they're not going to get back to the ROE that they had pre-crisis, I don't think. But Dennis, your head is about to explode, so I'll let you speak.
Well, I mean, when you say get beyond the rhetoric, I mean, they want to simplify the Volcker rule. The industry and the clearinghouse and your organizations complained endlessly about the Volcker rule. It was long, it was complex, my God, it's going to kill us. It was about 700 pages. So what have they done? They proposed a rule to simplify the Volcker rule, and it's 400 pages. That's the simplification. No complaints about that because it's deregulating. It's making it easy. Those 400 pages are great. The 700 pages that actually limited our prop trading, well, those are terrible and those are complex. And you can't look at, once again, you can't look at the Volcker rule in isolation. The Volcker rule, and by the way, Vice Chairman Quarles said this Volcker rule proposal, the 700-page one with 300 questions, was step one. So no, nobody's saying we need to get rid of the Volcker rule because that's politically impolitic. People do not want that. People are worried about Wall Street doing to them again what they did before. That's why you can't get a Republican in the light of day to sit here and sing the praises of deregulation and how he can't wait to vote for a Wall Street deregulation bill.
I think it's more that they just don't like me personally.
They don't want to do it in the light of day because they know the American people don't want it. But let's remember something else, too, that Jeremy alluded to. His organizations and the big banks all said when Dodd-Frank passed, it's going to kill the banks, it's going to kill our profits, it's going to kill our revenue. We won't be able to compete with the other big banks in the world. We won't be able to lend. And where are we? 2016, record revenue and profits. 2017, record revenue and profits. 2018, record revenue and profits. You can't say, don't use profits as a metric when you cried and fought against every reform by saying it's going to kill our profits. You can't say it's going to kill your profits then and then be wildly profitable and say, don't use profits against us. Most importantly, when they say you've got to do this and tweak that, they're entitled, whoever they are, whether it's the banks, a grocery store, or anybody else, to maximize their profits, increase their revenue in their businesses. God bless them, that's America. What we want to do at Better Markets and what regulators ought to be doing is thinking, let them do that, but there need to be rules of the road that protect Main Street, protect taxpayers, prevent bailouts, prevent crashes, and that they do things, I don't know, let's be crazy, legally. Let's stop breaking the law, let's say for a couple of weeks.
Yeah.
You have to take the bigger picture. Every reason used to argue against Dodd-Frank and the rules have been objectively proven false by profits, revenue, and bonuses. 2017 broke them. And we just saw in FT, big report in the Financial Times.
I'm not familiar with that newspaper.
I know. How the U.S.
I
banks,
worked there for years.
How the U.S. banks are killing the international banks in every sector.
All right. The clock, unbelievably, is at 0, and I'll get yelled at for keeping people on stage long, but I do want to give everybody the opportunity in like 10 or 15, 20 seconds to talk about when you think about the next crisis, the risks to the financial system, where we could see the next problem. Ken, you mentioned fintech is somewhere, but give me, when you think broadly about the financial system and the U.S. economy, what worries you?
Well, I think there are two problems. One is, can it finance our economy? I think small and medium-sized businesses have had trouble getting loans compared to before, and I think that's been a problem with the regulation in Dodd-Frank, so you'd like a system that let them get funding more. And then I guess make the point that fintech's really the place to look for the next crisis. We're talking about big banks. The problem of monopolies having a lot of power in the political system, growing like crazy in pharma, in every single area, food, is a problem in this economy, like we haven't seen for 100 years.
Gotcha. Congresswoman, let me let you take that one because I probably can't take everybody on this question. But let's say, Democrats come back to power, and so you win the House back, and let's just play out the scenario where you take the Senate too. Like, where would you focus in terms of going, to regulate further, and where would you find big risk in the system?
Well, I find big risks in the system, of course, with rollback of Dodd-Frank, as we've been talking about, but I really am concerned about income inequality. The last time we saw income inequality that was this great was during the Great Depression. And so that is the model for an economy that doesn't work. I think that we're making the same kinds of, with this tax cut, as our president so aptly called it, where 80% of the benefits go for share buybacks and stuff. We see people doing what they did during the crisis, chasing yield versus using that capital to raise wages, which not only have been flat, but we've recently seen that they are under. So all this notion of, oh, we have low unemployment and we're giving people bonuses. People's wages are less than they were, and income inequality greater. I think that the creation of bubbles, yet another bubble. We've seen bubbles in housing. We saw the bubble with in tech. There's another bubble coming as long as we're incentivizing chase and yield.
Okay. I could go for hours on this subject. We're going to let Jeremy and Dennis just fight it out in the back after we're done. So if you want to watch that, we'll do that. I apologize. We have such limited time. Dennis, thank you. Congresswoman, Jeremy, Ken, thank you so much.
And thank
you for all your time. Appreciate it.